Hello, everyone. I am Shaz. I'm the moderator for today's sessions. Welcome to this webinar that brought to you by Bursa Malaysia. How's everybody? All right. Good afternoon. Good afternoon. Hello. So today our webinar topic will be Bursa Mastery. This topic is fit for a beginner. And then, so today we will be having a special speaker, which is Shane Chu from Director of Revolve. Next slide. Mr. Shane Chu is a financial speaker, trader, and also an investor, and he is also a certified professional trainer. As a speaker, he always speaks regularly for BYIC seminar and also investment bank and also technical charting companies. And he is frequently invite guest speaker for over 20 universities nationwide to teach investment. So, Mr. Shane, how are you?
Yeah, I'm good. Thanks, Shaz.
All right.
Hello, everybody.
So before we begin the webinar, let me read the disclaimer. Okay, everything that we share in this webinar is solely purposely for educations, and this information is probably general information purpose only, and there is no investment advice or constitute legal or financial or trading. So if you we do not accept any liability. So whatever you invest or whatever you trade everything is on your own. All right. So I think I will pass back to you, Mr. Shane.
All right. Thank you, Shaz, for a kind introduction. So good afternoon, everyone. How are you guys doing? If you can hear me, see my screen, please type yes, okay, YES, and let me know if things are going well. All right. Thank you so much. I think allow us webinar until what time? It's until about 1 o'clock. So this session will last about an hour. Yeah, all right, thank you. So looks like everything is going well. So allow me to briefly introduce myself. My name is Shane Chu. I'm a financial speaker, trader, and investor for the past 10 years. I've investing experience since 2009. So I am often invited by investment banks, brokerage firms, securities firms to do talks and to train their clients in trading and investing. So far, I trained more than 20,000 people in stock investing. I'm also frequently invited as a guest speaker for 20 universities nationwide to talk about the concept of investing. So the highlight of my life came when I got acknowledged by the former US president, which is Barack Obama, for my work as a young leader in financial education. So that was me getting to meet some of the world's most powerful men. So right, here's the disclaimer again. So whatever we share in this webinar is only for educational purpose. So in no way that I give any recommendation for you to buy or sell any securities if we mention here. So if you decide to make any investing decisions, you're 100% responsible for your own risk. All right. So let's begin. Okay, today we have a very tight schedule. So I will go a little bit fast because I got a lot of things to cover. But before I begin, right, I just want to understand your background for a bit. All right, how many? Can you indicate to me what is the number of years of experience you have in the stock market? If you are new, you type 0. If you had 2 years of experience, you type 2. If you had 10 years of experience, you type 10. Let me know. All right. Okay, cool. Many of you here are pretty new, except Yongjun, who has 10 years of experience. All right. The rest of you are pretty newbie. All right, perfect. So today we're going to cover most of the basics of how to get started in investing and how you can, create your wealth through the stock market. So what we'll cover today is the importance of investing in the stock market, the basics of how the stock market operates, learn what factors move the stock prices, and learn how to read basic financial statements and learn how to identify investment grade stocks. So let's begin. So why should we invest? Now, because now we have entered an era of high inflationary pressure. Okay, this has, initially it was caused by the COVID-19 pandemic, which caused a lot of supply chain disruptions where goods are getting more and more expensive. Goods are stuck at the ports, so that caused a lot of supply chain problems. So that make things more and more expensive. All right. And then it got exacerbated by this geopolitical tension caused by the Russia invasion into Ukraine. So a lot of agricultural products, industrial metals, so are getting more and more expensive, right? So the transportation costs, the fuel get more expensive, then a lot more products get more expensive. So now we are facing a very high inflationary pressure from the world. Okay, not only Malaysia feels it, but the world feels it. Okay, in Malaysia we are pretty lucky. You know why? Because we still have subsidy for petrol, right? Our RON95 is subsidized by the government. So maybe we don't feel so much of the hike in petrol price, but if you're pumping RON97, of course you will feel the impact. But in other countries where the fuel or the gases, gas are not subsidized, so you will, they feel the transportation costs get more expensive. If things involve in transportation, right? Anything that involves in transportation will get more expensive. Okay, if your goods need to be transported, then it will get more expensive. So we can feel inflationary pressure everywhere. So in a high inflationary environment, if you're not investing your money, if you're just saving your money in the bank, then your purchasing power will be eroded, because inflation is going to eat up your purchasing power. So in a high inflationary environment, the last resort you want is to keep everything in cash, because inflation is going to eat up all your purchasing power. So now my question to you is inflation your friend or your enemy? All right, is inflation your friend and enemy or enemy? If friend, right, you type F. Okay, if it's enemy, then you type E. Okay, let me know. Let's do this as interactive as we can. Okay, many of you here wrote enemy, right? Dashini, right? Friend. All right. Now, of course, the answer to this question is depends on who you ask. If you're just a saver, then inflation is your enemy. Okay, but if you are an investor, then inflation could be your friend, because as things get more expensive, so will your asset prices. Okay, your property houses get more expensive. Okay, your the businesses will, the share prices will go up because of they have to charge higher for their product and services and so on. So if things get more expensive, so will investors' asset. So if you are an investor, then you can turn inflation to be your ally. Okay, but if you're just a saver, you save 100% of your earnings in the bank, then of course inflation will be your enemy. All right. So is saving alone enough? The answer is no. Why? Because saving is to save us from being poor, not to make us rich, right? But investing does. Okay? Investing can help us to achieve the financial goals that we set and we desire. Right? So why do we invest? Number one is we want to increase our current income, right? So do you ever feel that your income is not enough? Okay. Okay, if you do, right, maybe you type me, M-E. Let me know. If you feel that your income is not enough, you type me, right? If you want to increase your current income. Yeah, many of us invest because we want to increase our current income, right? And we want to achieve our financial goals, okay? Be it to buy a big house, also to improve our standards of livings, all right? And to prepare for retirement, okay? Some of us invest because we want to prepare for retirement, prepare for your for the education fund for your children, right? So these are the reasons why we need to invest. So what are shares? Okay, why we need to invest in shares? So let's begin. What are shares? Now, shares are actually ownership to businesses. Okay, when you invest in shares, right, you're actually investing in a fraction of a business, okay, of a company. Okay, so if you invest in shares, you could own shares of a listed company or Sendirian Berhad. But the problem is Sendirian Berhad shares, right, are not easily available to you because these are private limited, so they don't sell in public, right? But shares of public listed companies are available for sales on the stock exchange. In Malaysia, our only stock exchange is Bursa Malaysia, so you can purchase or you can sell the shares of listed company on the stock exchange. So now our life revolves around stocks, right? So when we wake up in the morning, okay, we are probably every day we are patronizing the products and services of listed company. Right? When you wake up in the morning, the first thing is probably your alarm rang, right? Your alarm could be Apple, Samsung, and so on, right? And then all these products are listed companies. So for example, if you're using iPhone, so you could be using Inari products because Inari supply radio frequency filter to Broadcom, which in turn supply to Apple. So you probably need to switch off your aircon. Okay, so your aircon could be made of Panasonic or other brands, right? Which could be listed in Bursa. Then you go to work, okay, you drive your Proton or your Perodua, okay, or all these companies distributing the cars are also listed on Bursa. You make a phone call, all the telcos that you use are also listed on Bursa Malaysia. You go to banks to withdraw money, so everything. So our life revolve around using the products and services of listed companies. So why don't we just flip our mindset, instead of just becoming a consumer, why don't we become an investor? All right. So why we need to invest in stocks, right? Number one is low capital cost, right? We can start as low as 100 ringgit, or a few thousand. All right, you can start as low as 100 ringgit or so. Okay, so this is an example of Inari. Okay, Inari, back in 2013, right? Inari was only one share of Inari is only 10 cents. So if you invested in Inari, right, just buy one lot of Inari back then in April 2013, right? It will only cost you 10 ringgit because one lot equivalent to 100 shares, right? 100 share times 10 cents is equivalent to 10 ringgit cost of investment. All right. So if you plus all the brokerage fee, probably cost you 20 ringgit. So as low as 20 ringgit, you can own a fraction of listed company shares, right? So if you hold it for 5 years, then you will be worth 2 over ringgit. Okay. So this is equivalent to a capital gain of 2,160%. In annual basis, it is 86.56%. So compound annual growth rate is 86.56% return a year. So the total dividend you receive is 21 times the dividend. Dividend yield is 342%. So the absolute gain from this holding period of 5 years of investing in Inari is 2,500%. Okay, today Inari share price is worth about 3 ringgit or so, plus minus. Okay, so this is not yet considering all the bonus shares, okay, through the bonus issue that you receive over the years. So you can see how many of you here would love to compound your money 25 times, okay, in the period of 5 years. Okay, so if you hold it until now, right, you could have compounded more, okay, because at one point Inari share price was about 4 over ringgit. Of course, now the war has caused it to decline back to about 3 ringgit level plus minus. So this is a benefit that stock investing can bring to you, right? So of course it gives us convenience. So long that we have internet connectivity and a device, we can make money anywhere in the world. No hassle, right? Unlike investing in other asset classes like property, you need to manage tenant, right? When it comes to investing in stocks, then not much hassle because you won't receive a call in the midnight and say, I got this problem with my house and so on, right? So no hassle in stock investing. And fourth is high liquidity. You can buy and sell at any time, okay, so long that market is open. So because all buyers and sellers of listed of business companies will aggregate at one place, and that is the stock exchange. So when you want to sell, there are ready buyers who want to buy from you. When you want to buy, there are ready sellers who want to sell to you. So so long that the price is following the market price. All right. Fifth is low transaction cost. The transaction cost to acquire or dispose of the stocks are actually very low. Okay, it's literally less than 0.6% or so. So low transaction cost. So compared to investing in other asset classes, right? So like in property, when you want to dispose your houses, right? Or you want to buy houses, right? You could pay agency fee, 2% already, and stamp duty and a lot more. So in stock investing, the transaction cost to acquire and dispose of assets are very low. And then we also have passive income, right? Passive income comes in the form of dividends. So when the companies make profit, then they'll declare dividend to you. Okay, so that is your passive income. All right. So and then the next is capital gains. And capital gains are tax free, which is very important. So capital gain happens when you buy low and sell high, right? And lastly is ownership. Okay, ownership means you can attend AGM as the legitimate shareholder. So long as you have one lot or one share, right, you're legally and legitimately a shareholder. So these are the reasons why we should consider stock investing. All right. And do you know that if you have purchased 1,000 public bank shares since 1967 and held it over a period of 51 years, your initial investment will grow to 3.7 million at the end of 2018, and you'll receive 1.3 million worth of dividend. So that's total of 5 million by the end of 2018. So this is the magic of compound return. All right. So this is what stock investing will bring you about, and that will give you around 19% compound annual growth rate a year in 51 years. Okay, throughout the 51 years period. So what are sectors that we have on Bursa Malaysia? Okay, on Bursa Malaysia, we have construction sector. Okay, can you name me a construction listed company in a listed company in construction sector on Bursa Malaysia? Okay, anybody? Gamuda, all right. MRCB, thank you so much. Consumers, products and services. Okay, anybody can think of consumers, products, services? This one we use, every single day, right? We have the likes of Nestle, yes. Okay, Pardini, okay. FNN, thank you so much. How about energy? Energy. Okay, actually Tenaga is not under energy, Tenaga, under utility. All right. We have Armada, all right. Thank you, Wilson. How about financial services? Maybank, right? Takafu, thank you so much. How about healthcare? Now, this sector was very hot 2 years ago, right? Thank you so much. Hata, IHH. So these are the pharmaceutical companies, glove companies, hospital chain, right? Top Glove, yes. Now, industrial products and services. These are the companies that involve in supplying goods and services to the manufacturer, like Semcam, Texcam. So these are not involved in petrochemical or plastic packaging like SCGM, Syntex. Okay, thank you so much. Or cement, aluminium. So these are companies listed there. How about plantation? Okay, I think this one everybody would know, right? KLK, thank you so much. Property. EcoWorld, all right, thank you. And how about technology? Just now we mentioned one stock, right? Inari, Dufu, all right. So these are companies that are involved in the semiconductor or hard disk, okay, spacer, telecommunications and media. Okay, TM, right? Thank you so much, DG. How about transportation and logistics? Transportation and logistics, GDEX. Thank you. Lee Truck. How about utilities? Just now, many of you here mentioned the name under energy, okay? But actually, the company is under here, okay? Yeah, Wilson said MFCB. That's right. MFCB is, have a hydropower dam. YTL Power, yes. Tenaga, thank you. And last but not least, REITs, Real Estate Investment Trust. SunREIT, thank you so much. So these are all the sectors that we have on Bursa Malaysia. That all the listed companies basically one or another is in one of these 13 categories. So if you want to buy, it's important that we know which sector they belong to, because different factors affect the stock prices differently. So it's important that we know the nature of business and which industry they are involved. So let's study the classification of stock. Now, this is not labeled, okay? This is not labeled under the stock category and so on, but this is something that investors must know so that we can make an informed decision. All right. So so it's important we learn this. So let's go through this list. So the first classification of stock is what we call a blue chip stock. So what is a blue chip stock? A blue chip stock, is a stock that has a long history of operation track record in the market. Okay, they are listed for longer period, probably over 20 years, and they command big market cap, and then they have a proven business model. They have solid distribution channel to distribute the products to their end users and so on. So these are blue chip stock. That means they have long history of operations, they have proven business model, and then they command big market capitalization. They are big companies. So that's what we call blue chip stock. Investing in blue chip stock typically gives us a lower bit of return, but then it gives us stability. All right. So this is what we need to know. So most of the blue chip stock are actually grouped under, are actually adopted as an index constituent under the FBM KLCI index. All right. So these are blue chip stock. Their PE typically is a bit lower, but then because they give stability, right? Because there's not much high growth is expected from blue chip, because they bring stability to your portfolio. So these are blue chip stock. All right. So the next category of stock is defensive stock. So what are defensive stock? Now, defensive stocks are stocks that are defensive against any economic cycle. Okay, good time, bad times, the business will still do well. Okay. Now, for example, all right, like consumer staples. Okay, good time, bad time, we still drink Milo, right? We still drink Nescafe, we still drink coffee, and so on. So these are all the defensive. These are companies that have the defensive nature. Good time, bad time, we still consume their products like tissue paper, and so on. These are defensive counter. All right. So defensive counter usually, it will also bring stability to your portfolio, because high volatility is not expected in this kind of stock. So these are defensive stock. Good time, bad time, the business perform. The third category of stocks or classification of stock is what we call income stock. Now, income stock, like the name suggests, right, give you a lot of income streams. Okay, these are the companies that probably reach a status, a point or stage that they will not experience super high growth. So based on this forward projection, right, the company has no reason to keep so much cash, so that's why they distribute a lot of cash as dividend to the shareholder. So if you invest in income stock, then you are likely to get a lot of dividend income. Okay, so of course, real estate investment trusts belong to this category. Okay, income stock. So some companies also declare like 5 times dividend a year. Some companies declare like 3 to 4 times dividend a year. So these are companies that have high dividend payouts, and then the dividend yield typically is more than 4% a year. So these are income stock. Okay, if you love passive income, then consider build your portfolio bigger with income stocks. Okay. Fourth is growth stock. Now, growth stocks is much smaller stock in comparison to blue chip. So these are companies which has which is still on high growth nature. They probably have a lot more new products or services not yet pushed to the market yet. They've only probably captured a certain fraction of the market share, and there are a lot more market segments that they haven't gone after yet. So these are companies which are probably newly listed for 3 to 5 years. They still have much room for growth to capture the market, or to come out with a newer product and services, or they are in a circular growth industry where the industry is going to experience circular growth over the next 10 years or so. So these are high growth stock. Now, usually high growth stock will command a higher valuation. they will command a premium valuation. That means they are more expensive. So these are high growth stock because investor price in for their future. So fifth is cyclical stock. Now, cyclical stocks, like the name suggests, is cyclical. That means the share price is in cycle. Okay, the share price sometimes go up, go down, go up, go down, go up, go down, and because the business have to go through, cycles. Okay, it's opposite to defensive stock. So that means in the economy good time, this business will thrive. Okay, they will make more sales in a economic robust period. But when it comes to economy recession period, then this kind of stocks will experience deterioration in their business results. So in economy recessionary period, they have less sales, because not many people have greater demand for their product and services in a recession. Right? So these are cyclical stock. Cyclical stock also are also those companies that follow the cyclical nature of the commodity boom and bust cycle. Okay, so this could be the stocks that will be, the businesses will be much influenced by the boom and bust of commodities such as crude oil, palm oil, okay, or the steel prices, aluminum prices, and so on. So in a commodity bull period, maybe they will do well, or commodity bear period, they will do badly. So this is cyclical stocks. Okay. Six is a turnaround stock. Now, turnaround stocks are stocks, like name suggests, is being turned around. So this kind of company probably experience a period of deterioration for a few years before they maybe appoint a new management to completely change or revamp their business model, or they push out a revolutionary product and services in hope to turn around their business fundamentals. Okay, so these are the turnaround stocks. So turnaround stocks are a bit more higher risk because there's no guarantee that the transformation plan or the turnaround plan will succeed. So this is turnaround stock. Then seventh is the sunset stock. Sunset stock, like the name suggests, right, is a company that is in a sunset industry, whereby the products, services are getting obsolete. Okay, and they are not forward thinking enough to turn around the business. So there will be lesser and lesser demand for their product and services. So these are sunset stocks. And the last is speculative stocks. Speculative stocks are stocks like in Malaysia, right? People like to goreng, or anywhere in the world, we like to goreng, right? Okay, so these are stocks that are probably worth a few penny, and then they experience great volatility in these stocks, and the business fundamental isn't that great, but then there are a lot of news coming out about these stocks, right? So these are stocks that we need to be aware, right? Now, so it is important for us to understand all this classification, because why? Because we want to know the risk level. Okay, I rank this kind of classification in from low risk to high risk. Okay, the higher it is, that means the lower risk it is. The bottom it is, right? Then the higher risk it is. So for me, right, I think investing in the last two categories, sunset and speculative stocks, are extremely dangerous, and I definitely definitely discourage all of us here to go after sunset or speculative stock, right? Because this is really tough. Okay, and for you, right, if you want to build more your portfolio towards stability, then you focus on the first three, right? Blue chip stocks, defensive stock, or income stock. If you want your portfolio to have a higher nature of growth, right, you can take a bit more risk, then go for growth stock, cyclical stock, and turnaround stocks. So these are the things that you need to know, right? But this is something that the stock is not labeled. Okay, like we know what is a stock code, what sector they belong to, but we actually don't know which classification do they belong to, right? So as an investor, it is important we know which sector they are in, so we know the nature of the business, and we can build our portfolio based on the type of companies that we want to invest, right? So like building a portfolio is like building a football team. If your strategy is to be defensive, then you get more defensive players, right? Like blue chip, defensive stock, income stock, right? If you are, if your style, imagine a football squad is attack, right? Then you build more, you get more strikers in your football squad, right? You get more growth stock, cyclical stock, turnaround stock in your portfolio, so that you'll be able to achieve higher return. All right, so it's important for us to know the classification. It's like when you buy property, you would know whether you're buying residential, you're buying commercial, you're buying industrial. So you must know which classification you are buying, right? But in stock market, it's also important for us to know, okay, which classification we buy, so we can build a portfolio that can meet our financial objective. Okay, is everything clear so far? If you are okay, right? Give me a 1. Okay, if so far so good, you give me a 1. All right, thank you so much. All right, cool. Okay, let's move on. So I saw some of you asking, what is stagflation? Okay, stagflation means that stagflation is a very high, there's very tough economic situations to manage. So stagflation means that inflation is high. So to counter the inflation, interest rate is also high. So inflation is high, interest rate is high, but then unemployment is also high, right? So we have 3 highs. Inflation is high, interest rate is high, unemployment is also high. So these are stagflation. It's an economic situation where it's very hard to manage. So far, we have seen that the world is on a high inflationary mode right now. So interest rate will follow suit, right? Will follow suit in hope to tame the inflation. But we haven't seen high unemployment rate yet. Okay, we may probably see it in Russia because got a lot of MNC withdraw from the market, right? So we will see whether stagflation will happen in Russia or not. But of course, hopefully not, so everybody can prosper, right? So, but stagflation is a really tough economic to manage because high inflation, high interest rate, high unemployment. So this is stagflation. All right. May we have example of companies, those stocks that mentioned just now? Oh, sure. Okay. All right. Let me go back. Now, blue chip stocks are the stocks that are, like in index stocks, right? The banks are all the blue chip, like Maybank, blue chip stock. Defensive stocks are the stocks, they are very defensive in nature, such as Nestle, okay, listed on Bursa, defensive stock. Now, income stock are stock that give you very high dividend yield, right? Or these are the real estate investment trusts, or some companies that give you, good cash, right? Like Bursa Malaysia, okay, stock code is 1818. Is also I think I classify that under income stock, because the Bursa Malaysia give quite high dividend payout. All right, so this is income stock, and Bursa Malaysia is monopoly. All right, would you want to own a business that's in monopoly? Right, no other. Everyone who want to be listed on the exchange, right? No, locally we have to go to Bursa Malaysia. These are income stock that give high dividend payout. Growth stock usually, most technology stock actually belong to the growth category, be a high growth, right? Like the like of Inari and so on. They still have a circular growth in the future. Cyclical stocks, for example, stocks that go through the plantation, okay, follow the commodity bull and bust cycle, plantations, or crude oil company, upstream oil players like hibiscus. So these are, or steel, okay, steel, like upstream steel player like Anju, or aluminium like Press Metal. So these are cyclical company. Turnaround stocks, a company that experience, deterioration and then being turned around. For example, in the past we have Proton, right? DRB Highcom, turnaround stocks. Or recently we have like Berjaya, right? Berjaya Corp, okay, got a new CEO come in, but of course now the new CEO, group of Berjaya Corp stepped down already. So these are turnaround stocks. Or DNEX, okay, probably also belong here, turnaround stock. When they have new acquisition, then they become a turnaround stock. Sunset stock is stocks that I think I don't want to mention. So in the sunset industry, right? Speculative stock is all the boring stock. All right. So these are the examples. Right. I have to move on already. So thank you so much for asking me questions. So I want to make this session as interactive as we can, so that we check in to see everybody is learning okay or not. All right. So the more energy you give me, then the more tips, idea I share with you. Okay, not tips. The more ideas I share with you. So this session don't have any stock recommendation. Now, market capitalization. So what is the size of the company? Now, size of the company is very important because we want to know what is the market cap. Okay, because if we know the size of the company, we will know whether this company is safer, or not so safe, right? Or speculative and so on. So that's something that we can take into consideration when we're evaluating the risk. Usually the higher the market cap, the lower is the risk, right? So how do we know the size of the company? We track by the market cap. Okay, market capitalization is the total dollar market value of a company's outstanding shares. So if you take this formula, you take the current share price times the total outstanding shares, it means the market capitalization. In short, market cap. So a company with we call big cap means that they are typically above 10 billion ringgit. Mid cap, that means middle capitalization, is probably ranging from 2 billion to 10 billion. And lastly, small cap is typically companies that is less than 2 billion, right? So less than 2 billion, a small cap company means what? Means that let's say the company is only worth, market cap is, let's say, 100 million. Okay, on Bursa, there are also many companies that are worth about 100 million. In other words, right, if there's one tycoon who has 100 million cash, right, in theory, they can buy all over the shares already in the market, right? A company that's worth 100 million, an investor can acquire, okay, the whole company with just 100 million. So that's what it means by market cap. How much it costs you to buy the entire company? This is market cap, okay, which is taking the consideration of what is the share price right now plus the total issued share number of shares. All right. So if you want to focus on stability, then go for big cap stock. If you want to go for growth strategy, then you go for small cap stock. So this is the trading hours. So for the for the sake of time, right? We just you just know that the market start at 9 o'clock and close at 5 o'clock. The first trading hour is 9 to 12:30, then close for 2 hours lunch break, then open another at 2:30 to 5 o'clock. Okay, so in one single trading day, there are 6 trading hours. Okay, 9 to 12:30, 3.5 hours in the morning, then 2:30 to 5 o'clock, 2.5 hours in the evening. Okay, in the afternoon session. So this is 5 trading days a week, 6 trading hours per day. So what move the share price now? So these are many reasons why the share price move, and of course all these reasons all boil down to one law, which is the law of supply and demand. The stock market works like an auction market. The more buyers there are in the market, then the share prices will be well bid, right? And when there's more sellers, then the share price will be suppressed. Okay, so the stock market will work like an auction market. So now the question here is, what changed the supply and demand dynamic? Okay, there are many factors. Number one, company performance. If a company is performing, okay, it's delivering better and better results every single quarter, then a lot more investors will demand of the asset, right? So that's number one. Of course, if on the other hand, right, the company is not performing as per market expectation, instead of growing every quarter, they were actually declining. Okay, they are still profitable, but then the profit keep declining, right? So they fail to meet market expectation. So in that sense, then investors do not like the company, then they will start to sell down. So in this case, right, there are more supply in the market because most investors want to sell, and there will be a fewer demand in the market because not investors like the company because they are in a declining phase. So market performance, okay, is the first factor that changed the supply and demand dynamic. The second factor is economy, right? In the economy robust period, more people will demand the asset, right? People have higher disposable income. People got pay raise, got incentive, got bonus, got promotions, right? So businesses are thriving. So people have higher disposable income. Then they will buy, they will demand more shares. Okay, so they have higher appetite for risky asset. But on the contrary, if economy is shrinking, it is in a recessionary period. So people have, pay cut, got laid off, okay, got no incentive, no bonus, businesses were ordered not to be able to operate. Okay, so in economic challenging period, then the disposable income of the people will actually be lowered. So the demand for risky asset will drop. On the other hand, the supply will increase because why? Most people have to maintain the lifestyle, have to sell their asset to convert to cash so that they can maintain the same standard of living. So this is economic factor. Okay. So the third factor is politics. Okay. Now, does politics affect our life? Yes or no, right? If yes, you type yes, okay? Let me know, okay? Does politics affect our life? Of course, yes lah. Some say why, okay, yeah, why stand for yes, right? And not only politics affect our life, right? It also affect the stock market. Like in the last general elections, right? When the ruling coalition got defeated at the poll, then the government-linked companies, or the companies that rely on government contracts, actually the share price seen that decline like 30%, 50%, 70% over a 1 month period, and that is bad for those companies, right? Because investor price in for the future. Okay, whoever get to be the government get to set the country's policies and so on, right? So that's why we must know where's the country heading to. Okay. And what are the policies there? Are they business friendly policies or not? Okay, so must be able to evaluate politics. So like in a time where political landscape in the country is not stable, then foreign funds will also leave the country. Like in every few years, we change government, right? We change the head of government, right? We change government and so on. Then in foreign fund managers also feel very, unsecure, okay, or insecure, right? Because in the event, sometimes their judgment could be right. Because of political turmoil, our currency weaken, right? Our currency weaken. Then if they are on paper, they make 20% gain, but then on currency, they depreciate 20%, right? Ringgit depreciate 20% because of politics reason. Then when they repatriate their funds back to their base currency, which is, let's say, US dollar, then they actually break even. Okay, so if any fund manager who invests in emerging market, then after a few years, they go back to the country and then repatriate the funds, go back to the country, and they break even, I think the fund manager will lose their job. So all the foreign fund managers, don't like country which is, politically unstable. So politics is also important to bring in, FDI and so on, so we can, increase the investment locally. Now, the fourth is institutional investment and divestment. Not only we are the only investors, okay, we also have institutional investors like pension fund, such as KDBSP, insurance fund, your mutual fund, and also sovereign fund like Khazanah, Khazanah or PNB. They are investing or divesting in the market. So these funds, they are billions in size or 100 millions in size, right? So they can move the market better than retail investors. So these are the funds that are buying and selling in the market. And fifth is foreign market. So if US do well, US go up 2%, okay, it's very optimistic, then you see that today the market will also open higher. So this is sentiment. Okay, foreign markets also affect the sentiment domestically. So 6 is natural disasters, where we hit with disaster, right? And then it could also cause the supply and demand change. Then of course 7 is speculative activities. There are people who are trading or market making, right? So these are activities that can change supply and demand. All right. So let's go to the market structure. Okay. So the market typically has 3 structures. So how do we make money? Is we buy low and we sell high, right? We want to buy at trough and want to sell at peak. That's how we make money. So when you see a series of higher high and higher low, when the highs are getting higher, when the lows are getting higher, these are what we call an uptrend. So this is the first structure. The second market structure is what we call a downtrend. When we have a series of lower high and the lower low. So when the highs are getting lower, when the lows are getting lower, so this is what we call a downtrend. And when we see the highs are getting, same level, and the lows are getting pretty much the same level, this is what we call a sideways or a range. So these are 3 types, okay? Uptrend, downtrend, or sideways trend. So which trend is easier to make money? Is it uptrend, downtrend, or sideways? Okay, maybe you can comment in the chat box, okay? Is it uptrend, downtrend, or sideways trend that is easier for us to make money? Okay, Muniz Warren say uptrend. Okay. All right. Okay, most of you here say uptrend, That's right. Okay. In my opinion, uptrend is the easiest to make money. Okay, we just trail along the trend. Okay, so our job is to find a stock that can, trend in a very nice fashion. Okay, how do we make money? Is buy low and sell high. Huh? So I got to go a bit fast. Okay, so today we talk about definition of investment. Okay, now today we focus on investing, and we're not going to talk about trading because I only have 1 hour. Looks like I need to speed up for a bit. So before we talk about how to invest, right? How to find investment grade stocks, let's define what is investment first. Okay, now, how many of you know who this gentleman is? Okay, if you know this gentleman, you type the name of this gentleman. Okay, now from the photograph, you know that this gentleman do not look like our time, don't belong to our generation. Okay, now this gentleman is famous for 3 things. Number 1, he's famous for being Warren Buffett teacher. He taught Warren Buffett about investing back when Warren Buffett was studying in Columbia Business School. So that's number 1. Number 2, he's famous for being the founding father of value investing. He even coined the term value investing. Number 3, he is the author of this book called Securities Analysis. Okay, he wrote the book Securities Analysis during the Great Depression and became famous. Okay, during the Great Depression, people were wary about the stock market as the stock market crashed 87% in 3 years period. So he wrote the book, the Securities Analysis, to tell people that, it is the best time to enter the stock market because good companies are selling at discount. Yes, Kelly and Muniz Warren is right. So his name is Benjamin Graham. Okay, so Benjamin Graham in his book, right? Securities Analysis has this profound sentence that I take the excerpt from. So this sentence, read like this: an investment operation is one which, upon a thorough analysis, promises a safety of principal and an adequate return. Operation not meeting these requirements are speculative. So there are 3 keywords here. Number 1 is thorough analysis. So if you are doing an investing and you do not do any analysis, right? Not let alone thorough analysis, you're actually not investing, right? You're actually speculating. So in investing, you must do thorough analysis. And analysis alone is not enough. You must do it comprehensively, 360 degree. You must understand the company inside out. That's what we call a thorough analysis. So that's the first keyword. The second keyword is safety of principle. Safety of principle means that whatever asset you invest in must at least assure you that the principle is safe there. Okay, it's not like the asset is, you don't know what the owner is going to use your money for, right? It must at least assure you that your principle is safe there. This second keyword. The third keyword is adequate returns. Okay, so because we are not doing philanthropic work or charitable work, right? In investing, we park away our hard-earned money into asset that we expect a yield. Okay, so we expect an adequate return. So these are the 3 keywords that will make an investing valid. And this is a definition of investment. So first keyword is must do thorough analysis. Second keyword is it must at least assure us the safety of principle. And third is adequate return. Any one missing, you are not investing, you are speculating. All right. So speculating means you're gambling. So this is the definition of investment. So, okay, so we have just defined investment, right? So let's understand a bit. What are the steps in investing? Okay, now when it comes to investing, we must follow this exactly 3 steps. Okay, now these 3 steps are designed in such an order that you should not jump the gun. You must follow exactly first step do what, second step do what, and third step do what. Okay, the first step is we must invest in the right business. Okay, we must evaluate the business model. So a lot of times, right, retail investors invest in the market, right? They don't really understand which company they invest. Just remember the stock code. Okay, this is the stock code. Okay, my friend said it will go up. That is the surest way to fail in the stock market, right? So the first thing is not only we need to be able to understand, to tell what business they're in, we'll be able to understand the business model. Okay, so like a lot of investors say, oh yeah, I know this company is in semiconductor. Okay, but what business do they precisely do? They are not so sure. Okay, so the first thing is you must understand the business model. Okay, how do the business work? Okay, like who are the clients? Okay, what are the cost structure? Okay, how do they distribute their product and services? Okay, what are the market share, right? So what is their competitive advantage in this industry? Okay, how do they make money? Okay, is this business sustainable or not? So these are questions that you need to think before you invest in a company, right? So that's the first step. We must understand the business model. We must find the right business to invest in. First step. Only when you like and you feel optimistic about the business prospect and you think the business model is great, then you go to the second step. Okay, the second step is to study the management. Okay, so a management is also important because a business is like a ship. A management is like the captain of the ships. If the business are not doing well, okay, if the business is doing okay, but the management is not credible management, and this management looks like not competent at their job, the ship will also sink, right? No matter how strong the ship is, right? If the managements are lousy, then the ship will also sink like Titanic. Yes or no? So that's why the captain is very important. Okay, not only the ship or the aircraft has to be top notch, right? The captain need also be, a certain level of caliber and competence. If the captains are lousy, then the aircraft will also sink, right? So that's why management is important. In fact, I think management is even more important than business. But because evaluating management is very subjective, all right, and it involves a lot of qualitative aspect of you understanding a business and the character, so it is not as easier, huh? But of course, what we look for in the management is, number one is, of course, whether they're experienced or not, they have a proven track record or not, and of course, whether they have integrity or not. Okay, do they create wealth for shareholders? So these are the questions that we need to ask. Have they been good in have they been good in making sound business decisions? Or their judgment is always not so good, right? So the least you must do as an investor is to attend the AGM so you can meet the management eyes to eyes, right? So some of us here have intuition, we have instinct, right? When we see people eye to eye, right, sometimes I feel that this guy looks like cannot be trusted, right? So the least you must do is to attend the AGM so you can understand what is the management plan going forward. And that is very important, right? Are they trustworthy or not? Okay. Have they been, do they look after minority shareholders, or they just look after their own interests? So these are questions that we need to ask when it comes to evaluating the management. So only when the first step, right business, is okay, second step, the management is also okay, then we go to the third step. Okay, if the first step not okay, then you don't bother to go to the second step. You find the next company, okay, with a right business model. Okay, so if first step is okay, we go to the second step. If management is also okay, then we go to the third step. If the management you feel is someone that whom you think could be, doing, could be something a bit fishy, something that you cannot trust, then you skip. You don't bother to do the third step. Okay, you just move on, because there are like 900 over companies, okay, listed on Bursa, right? Plenty of companies for you to choose, right? Just find the next company. If first step and second step are okay, then go to the third step. The third step is to study the price. So not only we need to buy the right business, right management, we also need to buy it at the right price. So that's where the third step is important. Now, a lot of retail investors, they invert the order. So the first thing they go to the market is they evaluate, okay, whether this price is cheap or not. So we don't want to invert the order. We want to do it exactly this order. Okay, the price is the last thing that we want to do, because you want to buy in the right business, right management. After that, you only evaluate, is the price right? If the price is expensive, then you wait for the price to decline to a level whereby it is more, it can, give you a better risk to reward ratio. It can give you a better investment merit when it is cheaper, then you buy them. Okay, a good business may not be a good investing, okay, because sometimes good business sell at exorbitant price, right? We want to buy a good business at a good price. That is investing. All right. So where do we find all this money-making information? We all want to find this money-making information, right? So we can find all this important information, from the financial statements. Okay, the income statement, balance sheet, and cash flow statement. Okay, let's go into it one by one, right? So all these financial statements can be obtained from Bursa Malaysia website, or from the investor relations website of the listed company, or in the annual report So you can find them in the annual report. So why is this important, right? So income statement. I think that not all of you here are accountants. So let's go through all these statements one by one. In a layman term, right? What is an income statement? Now, income statement is a statement of a company's health. Whether a company is healthy or not, we look at the income statement that we know. A company that's healthy is a company that is profitable. Okay, and they are profitable. Profitability determine the health of a company, right? So what do you look at? So income statement keep tracks of the top line and the bottom line, how much sales they come in and what are the expenses, right? So the item in notes in an income statement is to understand the top line. Okay, I know where is the sales right now? Are they increasing? Secondly, is to understand the net profit. Okay, how much what is the bottom line right now? And the third is net profit margin. What is the margin that this company are getting? Okay. So, and then sometimes we look into dividend. If dividend yield is important to you, so you look at dividend. Okay. A company that is not healthy is a company that is losing money. Okay. They have sales, but then at the end, right, at the bottom line is negative. Okay, they are deficit. They are loss-making company. This is a company that is unhealthy. Okay. So the second statement that we must learn is a balance sheet. Okay, what is a balance sheet? A balance sheet is a statement of a company's wealth, whether a company is wealthy or not. Okay, so we look at balance sheet, right? So what are items to note? Items to note are the net worth, total shareholders fund, book value, owner's equity, and net asset, right? So all these are key metrics, and these all mean one thing, which is owner's equity. Why are there so many names, right? Because maybe they are created deliberately to confuse you. Okay, so of course I'm joking. Of course there are many names to this, but all essentially they mean the same thing, which is equity. Okay, net worth, total shareholder fund, book value, owner's equity, net asset, right? Anytime this thing mentioned, right, is referred to the same thing only, which is the owner's equity. Okay, the ultimate job of any business is to increase the equity, okay, over time, right? So that is the priority. So second is you want to know what is the total liabilities, okay, how much debt they borrow. And third is you must know what is the current asset, current liabilities. Current means that anything that's less than 12 months. Current asset means that wherever asset that can be converted to cash and equivalents in the next 12 months, these are current asset. So these are like your marketable securities, your cash and equivalents, your accounts receivable, so these are all your inventory. So these are all the current assets. Current liabilities means the short-term debt that you need to pay within the next 12 months. So these are short-term debt and loan, accounts payable, and so on. These are other current liabilities. And next thing, I also want to understand the net tangible asset. For me, because I don't have time to evaluate every single item, so I just focus on the big item. So that's how we can accelerate our efficiency, okay, in analyzing a company's statement. All right. So the third statement is cash flow statement. A cash flow statement is a very important statement as well. A cash flow statement will tell you the statements of a company's condition. All right. So whether this company is in good condition or not. Okay. So a company that's in good condition must have healthy operation cash flow, right? So these are three things we study. Number one, we study the cash flow from operating activities. Number two, we study the cash flow from investing activities. Number three, we study the cash flow from financing activities. Cash flow from operating activities means that all the cash inflow and outflow from day-to-day business operation. Are they getting cash from their business, or they are losing cash on the business? So this is the priority. A company that's in good condition must have positive operating cash flow. Second, cash flow from investing activity means all the cash inflow and cash outflow from all their investing activity, like capital expenditures, okay, whether they have disposed of all the property, plant and equipment as well. So these are cash inflow and cash outflow from investing activities. If they sell the asset, then they have positive cash flow from investing activity. If they acquire asset, then they have negative cash flow from investing activities. So cash flow from financing activity means that all the fundraising that they do, right, all the dividends paid out, what they do, right? So if a company with negative financing cash flow, financing cash flow, will means that the company is paying out dividends. Okay, will probably mean, So a company with positive cash flow from financing activity means that they are doing rights issue, they're doing private placement to raise funds from equities or to raise funds from the bank, right? To borrow from bank. So this will see positive operation of positive cash flow from financing activities. So a good company, that's a company that's in good condition, needs to always have positive operation cash flow. So you want the cash flow from operating activity to be always positive, because they are, money coming in, cash coming in. To me, right, the cash flow from operating activities is the most important. Okay, because a company could be healthy, they are profitable company. They could be wealthy, they got a lot of cash, they got a lot of asset, right? They have very little debt. It could be a wealthy company, but then the company could be in bad condition. Why? Because they cannot collect cash from their clients. The clients don't want to pay them. Okay, we see their accounts receivable keep expanding. The companies is profitable, but then they cannot collect cash, right? Their account receivable keep expanding. So in this case, we see that the cash flow for operating activities is always negative. Okay, so that means the company is not in good condition. They could be healthy, they could be wealthy, but they are not in a good condition. It's like us lah. We could be a healthy person, we exercise every single day, right? We could be a wealthy person, okay, we make a lot of income, right? We are cash rich and so on, right? But now we are in bad condition. Why? Because now we are down with dengue, or we contracted COVID-19 temporarily, right? So sometimes a company, a person could be healthy or wealthy, but not in good condition. So when we invest in this company, we have to look for the same sign, right? We want a company which is healthy, we want a company which is wealthy, and we want a company which is in good condition. All right. So cash flow statement is very important, because while income statement is created based on accrual basis, cash flow statement is on cash basis. Okay, so income statement is easier for you to change the bottom line for a bit because of different accounting standards. Cash flow statement is very straightforward. Okay, whether you got cash in or cash out. So a telltale sign, you want to know whether this company is good condition or not, you must look at cash flow statement. That's very important. All right, so now we have come to the last part, okay, which I think I've reached my time. So how do we find investment grade companies? To find investment grade companies is as easy as common sense. Okay, so it does not take rocket science. Number one, we want a company which has consistent profit growth. We want a company that are growing the profit every single year. Okay, we want to invest in company where the profit keep growing every single year, right? We want a consistent profit growth. Do we like first year they make 20 million, second year they make 40 million profit, third year they make 60 million profit, and last year they make 100 million profit? So these are companies that we like because when they have consistent profit growth, so will the share price. But usually the share price tend to mirror the earnings performance. All right. Do we want to invest in company that first year they make 100 million profit, second year they make 18 million, next year they make 60 million profit, and last year they make 20 million profit? Is it a company that we like? The answer is no. You know why? Because these are in a declining phase. The company keep declining their profit. In fact, they don't have consistent profit growth. They got consistent profit decline. And when they have consistent profit decline, the share price tend to decline. Okay, so this is the first criteria. We want to only invest in companies that are consistent in terms of profit growth. So this is the first criteria in finding investment grade company. Number two is little debt. Okay, we want a company which has as little debt as possible. Okay, am I okay if got debt? Absolutely. Okay, am I okay if got too much debt? Of course, this is raise the risk. The higher the debt, the bigger is the risk level. Okay, because in an economic recessionary period, then the debt will burden them, because when the demand of goods and services is dampened, then they will have a hard time to get in cash, right? So in an economy bad time, then the high debt company will be challenged. So the higher the debt, the higher is the risk. The lower the debt, the lower is the risk. Okay, but of course it can't be avoided lah. A company will need to grow. Some companies will need to grow by borrowing. So no choice. So but we only want, I think the investment grade company have conservative debt financing. The third is strong cash flow. Strong cash flow, cash is very important, right? A company can only grow as far as the cash flow allows. If the cash flow does not allow, the company cannot grow. So that's why cash is very important. Cash is king, right? So when you got no cash, you cannot pay your employees, cannot pay your suppliers, cannot pay rent, right? A lot of things you can't do. So when you got cash, right, when good opportunity appear before you, you can seize them. You can grab them and you can make good investment decisions. So that's why cash is very important. Okay. When a company run out of cash, then they will be insolvency crisis. The fourth is increasingly more dividend. Now, I think a lot of you here love passive income, right? If you love passive income, then the fourth criteria is very important, increasing dividend, right? We want to invest in a company that gives us more and more dividend. So our portfolio, so we can get a lot of passive income along our investment journey, and we can be financially free, right? When we got a lot of dividends coming in, then no, we can get our expenses taken care of. So these are the characteristics of investment grade company, in my opinion, that investors should focus on. So of course, the more it hit, right, the lower is the risk. The more things that you don't hit, right, then the higher is the risk, in my opinion. So if you see investing does not take rocket science, so any of us here can do that. Okay? Just so long that we follow this common sense criteria, then we should be able to do fine. All right. So yes, I've come to the end of my segment. I think I overshoot for about 5 minutes. So I'm opening up for questions. So if any question, you can address to me. So Shaz, I leave it to you.
Okay, thank you, Mr. Shane Chu, for your insightful sessions. And thank you for walking us through on how to start investing. So if you have any question, can you please write your question in the Q&A session, in Q&A box. Okay, we have a question from Sanjeev Kumar. Is it the book value and net asset, is it the same?
Yes, correct. The book value and net asset are the same. They refer to the same thing, which is equity.
Okay, next question from Yung Jung Fa. And from Sanjeev Kumar again. How to do management analysis on 900 companies? Do you have a tool or indicator to do that?
Well, of course, we all have limited time, right? Time is very scarce. So it will take you a long time to do analysis on 900 companies. So what you can do is you can, based on, in this case, you can based on top-down approach, you identify which are the top trending, which are the industry with growth, then you want to focus on. Then you can, just go within that sectors to find the top performing company. You can use screeners. Okay, you can use screeners on Bursa Marketplace. That's where you can find, you can put in your criteria. For example, you want company which is one company which is more than 1 billion in terms of market cap. You want a company which can give you a return on equity more than 12%, or you want a company which gives you a dividend yield of more than 2.5%, or you want a company which is not so expensive, the PE is reasonable, then put PE less than 15 times, for example. Then you can use the screener on Bursa Marketplace to help you to narrow down the list of companies that meet your criteria. Okay, so you can use those kind of tools provided by Bursa Malaysia for free. Okay, all these tools are free, and you can use it to help you to pinpoint. So this is bottom up. Bottom up means you use micro. You do analysis on a micro basis. Then you find companies. Top down means you find sectors. Okay, you find sectors that you think will benefit from next paradigm shift in economy. Then you go, you find which is the best performing stock in that sector. Then you do analysis on that. So these are some top down and bottom up approach that you can employ to find the to find the right investment for you.
Okay, thank you, Mr. Shin. Shin, can you tell us any example of good company?
Of course, I can't give any recommendation, so maybe I will skip that. So yeah, so all the good companies follow the criteria that I've just said, right? Investment grade company are companies with consistent profit growth, conservative debt financing, strong cash flow, and give you increasingly more dividends. Huh?
Okay, I think we all already exceed the time. So if you have any more questions that we didn't have enough time to answer your questions, kindly please, can you go to next slide? Oh, you can go to the, yes, Shinchu Facebook, which is Shinchu7. So to ask more questions, any question if we didn't manage to ask. All right. So we have already reached the end of our webinar. Once again, thank you, Mr. Shins, and thank you to all our participants today for joining us today. Have a good day, Mr. Shins, and have a good day, everyone. Shaz here, signing off as a moderator. All right.
Okay, bye everybody. Hope to see you again.
Thank you.
And wish you the best in investing.